Let me save you some time and potentially make you some money. Most people overcomplicate investing, but the truth is, the secret to finding the best companies to invest in is quite simple. It's all about identifying businesses with a durable competitive advantage. Companies that possess this trait consistently outperform their competitors, weather market storms, and generate long-term value for shareholders. In this video, I'll walk you through the essential steps to spot these businesses that are primed for long-term success. If you've ever been confused about where to put your money or worried about making the wrong investment, stick around. This framework will simplify the process and boost your confidence in making smarter investment choices. Let's jump in. Step 1. Look for a competitive advantage. The cornerstone of any great investment is understanding the company's competitive advantage. A competitive advantage is the unique factor that allows a company to outperform its rivals. It's the secret ingredient that keeps competitors at bay and ensures the business's survival and growth over the long haul. Think of brands like Apple or Coca-Cola. Both have built moats around their businesses, making it incredibly difficult for newcomers to topple their success. In the simplest terms, a competitive advantage can come from several sources. It might be a brand with loyal customers, an innovative product that competitors can't replicate, or cost advantages that allow a company to produce at a lower price. One company that has been exceptional in leveraging its competitive advantage is Microsoft, under the leadership of Satya Nadella. Nadella's emphasis on cloud computing and software ecosystems has created a powerful moat around the company, making Microsoft indispensable to businesses globally. It's important to recognize that not every company has a lasting competitive advantage. Some might have an advantage temporarily, but only those with durable advantages will thrive in the long run. When analyzing company, ask yourself, what sets this company apart? Can its competitors easily replicate this? Reading the identifying competitive advantage, you'll see that the best companies create barriers that protect their profitability for years, sometimes even decades. Whether it's network effects, economies of scale, or proprietary technology, a true competitive advantage is what keeps competitors at bay. So when you invest, focus on companies with strong, lasting advantages. This way, even when market conditions turn, these companies continue to excel. Step 2. Check the company's financial health. The next step is understanding the financial health of the company. In investing, numbers don't lie. A company with excellent fundamentals can withstand short-term market volatility and thrive over time. Key indicators like revenue growth, profit margins, and free cash flow are essential metrics that can give you a snapshot of a company's financial health. One of the most crucial metrics for long-term investors is free cash flow. Why? Because free cash flow is the lifeblood of any business. It's what's left after a company has met all its capital expenditures. This is the money that can be used to pay dividends, buy back shares, or reinvest in the business. Companies like Coca-Cola and Apple have consistently generated high levels of free cash flow. This consistency is a sign that the business has robust operations, and more importantly, it shows that the company can weather economic downturns without being forced to take on debt. The cash flow is far more critical than revenue growth in isolation. A company that generates consistent free cash flow is in a far better position to reward its shareholders over time. Also, companies with high levels of cash flow can make smart acquisitions, invest in new technologies, or return value to investors through dividends and buybacks. When evaluating a company, you don't have to get into overly complex financial statements. Simply focusing on free cash flow, manageable debt levels, and consistent profitability is a great starting point. Make sure the company isn't burning through cash or reliant on massive amounts of debt to stay afloat. Step 3. Evaluate the leadership team. A company is only as good as its leaders. No matter how promising a company's product or service is, poor leadership can run it into the ground. That's why it's critical to assess the management team when considering a long-term investment. Leaders who innovate, inspire, and have a clear vision for their company are the ones who drive success. Look at Satya Nadella of Microsoft. Since taking the helm, Nadella has transformed the company into a cloud computing powerhouse, ensuring its relevance and growth for the foreseeable future. Under his leadership, Microsoft has seen continuous revenue growth, strong profitability, and innovation that has kept it at the top of the tech industry. A strong leadership team can capitalize on competitive advantages and steer a company towards sustainable growth. When assessing management, look at their track record. Have they been able to consistently grow the company? How do do they handle crises or downturns? Are they forward-thinking? And do they have a clear vision for the company's future? You don't need to be an insider to get a sense of a leadership team's effectiveness. Regularly reading interviews, listening to quarterly earnings calls, and checking how management responds to challenges can give you valuable insights. Great leaders inspire loyalty in their employees and customers, driving the company toward long-term success. On the flip side, constant leadership turnover or poor decision-making can be red flags that signal instability. Step 4. Market potential and cash flow overgrowth. This step might surprise some. It's not necessarily about picking companies in fast-growing industries. Sure, growth is great, but it's not the be-all and end-all. In fact, many of the best investments come from companies in mature industries that generate high levels of free cash flow. Think about Coca-Cola or American Express. These companies aren't in booming industries, yet they consistently produce exceptional cash flow, rewarding investors year after year. While growth can provide opportunities, it's the consistent generation of cash that ensures value over the long term. High-growth companies often reinvest all their profits back into the business, leaving little room for shareholder returns. Meanwhile, companies with steady, predictable cash flow, like Apple and Coca-Cola, can distribute dividends, buy back shares, and make strategic acquisitions that create additional value for shareholders. The key here is to focus on companies that can sustain their profitability, even in a slowing industry. The growth of the industry might not be huge, but if a company has a dominant market position, low costs, and consistent free cash flow, it becomes an excellent long-term investment. When evaluating market potential, don't just look for the next big thing. Instead, focus on companies with strong fundamentals and steady cash flow. These businesses are often overlooked but can provide significant long-term value. Step 5. Look for sustainable growth. Last but not least is sustainable growth. Every investor dreams of finding the next big growth story, but rapid growth without a solid foundation can often lead to disaster. What you want is steady, reliable growth that lasts over time. Take Amazon, for example. It didn't explode overnight. Instead, it spent decades building out its logistics network, expanding its services, and growing steadily. This type of long-term strategy allows companies to avoid the boom and bust cycle that's often associated with flashy startups. Sustainable growth comes from a company's ability to reinvest in itself, innovate, and adapt to changes in the market. Companies that focus on steady growth over time build strong customer relationships, maintain competitive advantages, and continue to generate value for shareholders. You should avoid companies that grow too quickly without a clear long-term strategy. Fast growth can be exciting, but it's often accompanied by high risks. Instead, look for companies that can sustain moderate, consistent growth over time. These are the companies that will build lasting wealth for their investors. Now that you have a better understanding of how to pinpoint the best companies to invest in, it's time to put this strategy into action. Focus on companies with durable competitive advantages, strong financial health, effective leadership, and consistent cash flow. This framework will guide you in making smarter investment decisions and building long-term wealth. If you found this video helpful, please give it a thumbs up and subscribe for more insightful investing strategies. Remember, successful investing is all about being patient, well-informed, and sticking to a strategy. Keep learning, stay curious, and watch your wealth grow over time.